Feeling like you're stuck in a financial rut? Maybe you're thinking you need to juggle a dozen side hustles or land a six-figure job just to get ahead. But what if the secret to building wealth is actually simpler than that? What if all you needed was a little advice from someone who truly understands money? I'm talking about the one and only Warren Buffett, the Oracle of Omaha. With a net worth that's hard to even imagine, you might think his advice is too complex for the average person. But that's where you'd be wrong. Over his incredible 60-year career, Buffett has shared some of the most practical, down-to-earth financial wisdom you'll ever hear. Today, we're diving into 13 of his golden rules that can help anyone, and I mean anyone, start building a more secure financial future. Let's start with his first piece of advice, which is all about perspective. Start small and be patient. Buffett famously said, "Someone's sitting in the shade today because someone planted a tree a long time ago." This is so powerful. He didn't start his journey with millions of dollars or a massive social media following. He began with what he called a tiny amount of money. His strategy was simple. He'd find a small, promising company he believed in and invest in its potential. He saw the power in starting small because it gave him the freedom to choose these overlooked gems. And guess what? This is a strategy you can use right now. You don't need a fortune to begin. Find a company whose products you use and believe in, invest what you can afford, and then practice the art of patience. Let time and growth work their magic. As Buffett himself said, if you're working with a small amount of money, you can make very significant sums. It's about planting your own financial tree today so you can enjoy the shade later on. Next up is a piece of advice that takes the guesswork out of investing. Invest in index funds. In today's world, we're all looking for ways to make our money work for us, and Buffett has a favorite recommendation for most people. He says, "In my view, for most people, the best thing to do is own the S&P 500 index fund." So what exactly is an index fund? Think of it as a basket of stocks that tracks a specific part of the market. The S&P 500, for example, holds stocks from 500 of the largest and most successful companies in the United States across various industries. By investing in an S&P 500 index fund, you're not putting all your eggs in one basket. Instead, you're spreading your investment across a wide slice of the economy. Buffett loves this for everyday investors because it's simple, diversified, and has historically performed well over the long term. It perfectly aligns with his most famous rule of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. An index fund helps you play the long game while managing risk. It's a classic work smarter, not harder move for your money. Moving on to our third point, which adds a layer of stability to your portfolio, buy bonds. While stocks get a lot of the attention, Buffett knows the importance of balance. He's not just about going all in on stocks. In a letter to shareholders, he revealed the instructions he left for the trust that will manage his wife's money. The plan is surprisingly simple. Put 90% in a low-cost S&P 500 index fund and the remaining 10% in short-term government bonds. So why bonds? Government bonds are essentially loans you make to the government, and in return, they pay you interest. They are considered one of the safest investments you can make. This 10% allocation acts as a safety net, a stabilizer for the portfolio. When the stock market is volatile and goes on a roller coaster ride, bonds tend to be much more stable. For U.S. investors, you have options like treasury bonds or savings bonds, which are accessible with as little as 25s. It's a simple, effective way to add a dose of security to your investment strategy, straight from the Oracle himself. This brings us to a crucial principle that underpins all of Buffett's strategies. Understand your investments. Buffett once warned, "Risk comes from not knowing what you are doing." This is so important. When it comes to your money, knowledge truly is power. Now, this doesn't mean you need a PhD in finance or that you have to understand every intricate detail of the stock market. If that were the case, very few of us would ever invest. What it does mean is that you should have a basic understanding of where your money is going and why. You've already taken a great first step by learning about index funds and bonds. If you're interested in another type of investment, say a specific company's stock or a different kind of fund, take some time to do your homework. Read up on it, understand how it makes money, and what the potential risks are. The more you know, the more confident you'll feel in your decisions, and the less likely you'll be to make choices based on fear or hype. And remember, if you ever feel overwhelmed, there's no shame in seeking guidance from a qualified financial advisor. Buffett's fifth piece of advice is all about mindset. Don't follow the crowd. In an era of social media trends and viral stock tips, this might be his most important lesson. Buffett said, "The most important quality for an investor is temperament, not intellect." He explains that you need a temperament that doesn't get swept up in the excitement of being with the crowd or the thrill of going against it. Think about it. Buffett didn't become one of the wealthiest people in the world by jumping on every hot trend. He built his fortune by doing his research, finding great companies he truly understood and believed in, and then holding on to them for the long haul. He focuses on a company's fundamental value, not its popularity at the moment. When you understand your investments and have a clear strategy, you don't need to worry about what everyone else is doing. You can tune out the noise, avoid making emotional decisions, and stay focused on your own long-term goals. True success in investing comes from independent thinking, not from following the herd. Now for our sixth point, a piece of practical advice that has saved Buffett and our own company time and again: keep cash available. Buffett has a great line for this. When bills come due, only cash is legal tender. Don't leave home without it. While he's a huge believer in investing for the long term, he also knows that the market can be unpredictable. Having cash on hand is your ultimate safety net. Look at the 2008 financial crisis. While many companies were struggling or even collapsing, Buffett's company, Berkshire Hathaway, was able to thrive and even make strategic acquisitions. Why? Because they had plenty of cash ready to deploy. For us, this means having an emergency fund. This isn't just money sitting in a checking account. It can be in what's called cash equivalents, things like high-yield savings accounts or money market accounts. These are safe places where your money can earn a little interest, but is still easily accessible when you need it, whether for an unexpected emergency or a great investment opportunity that suddenly appears. Having that liquidity gives you financial flexibility and peace of mind no matter what the market is doing. Our seventh tip, and this one is a game changer: pay off your credit cards. When a friend asked Buffett what to do with some extra money, he didn't say, "Buy this stock." He said, "Pay off your credit card debt." Why? Because the interest rates are sky high. He called it a guaranteed return. Before you even think about investing or side hustles, getting out of that high-interest debt spiral is like giving yourself an instant raise. It frees up your cash and stops you from paying someone else for the privilege of being in debt. Next, Buffett teaches us to think about value, not just price. He famously said, "Price is what you pay, value is what you get." This isn't just about stocks. It's about everything you buy. Instead of asking, "How much does this cost?" ask, "What will this do for me in the long run?" A cheap phone that breaks in a year isn't a good value. A quality item that serves you well for years is. It's a mindset shift from short-term cost to long-term benefit. This leads perfectly into his ninth piece of advice: buy quality at low prices. Buffett loves a good deal, saying, "Whether we're talking about stocks or socks, I like buying quality merchandise when it is marked down." The key word here is quality. A bargain isn't a bargain if the item is junk. The smart move is to identify things that have real, lasting value and then wait patiently for them to go on sale. This way, you save money without sacrificing quality, which is the ultimate win. 10th one, act on opportunities. Buffett has a great saying: "When it rains gold, put out the bucket, not the thimble." Great opportunities don't come around every day. When the market conditions are just right or a fantastic deal pops up, you need to be ready to act decisively. This doesn't mean being reckless, but it does mean that when a truly golden opportunity presents itself, you should go big. Don't just dip your toe in, fill your bucket. Being prepared and bold at the right moments is crucial. Number 11 is all about having a margin of safety. Picture this. You wouldn't drive a 9,800-pound truck over a bridge with a 10,000-pound limit, right? You'd find a stronger bridge. The same logic applies to your finances. This means building a buffer. Before you take big investment risks, make sure you have a solid emergency fund. Don't invest money you can't afford to lose. This margin of safety protects you from unexpected setbacks and allows you to make financial decisions from a position of strength, not desperation. Our second last is focus on the game, not the scoreboard. It's so easy to get obsessed with checking your stock portfolio every 5 minutes, watching the numbers go up and down. Buffett advises against this. He says games are won by players who focus on the playing field. For us, that means focusing on our long-term strategy, saving consistently, choosing solid investments, and not panicking over daily market fluctuations. Play the long game. If you're unsure, robo-advisors or financial professionals can help you stay focused on the field. Finally, and maybe most importantly, keep it simple. You don't need to be a Wall Street genius to get great investment returns. Buffett stresses that you should never swing for the fences. If something sounds too good to be true, like a promise of quick, easy profits, your answer should be a quick no. Be the tortoise, not the hare. Slow, steady progress with a simple, understandable strategy is what builds real, lasting wealth. It certainly worked for him. So there you have it. 7 powerful, practical principles from Warren Buffett. Which one resonated with you the most? Let me know in the comments below. Thanks so much for watching. If you found this helpful, please give this video a thumbs up and hit that subscribe button for more content to help you master your money. See you in the next one.